Hi, Greg Weldon here with Weldon Live for Thursday, August 18th, and today it's a 2-in-1 special. Part 1, I look at the retail sales numbers, slice and dice the data, talking about the way in which this news was celebrated by the pop media. Nothing worth celebrating within this number. It really is no growth at all in retail sales. As a result of that, I look at the consumer sector, the consumer discretionary, the retail, tie in the Dow, the S&P, and look at Walmart and Amazon specifically as part of the retail sales stock market part 1 of today's live. And then in part 2, it gets even better. As late in the day, Wednesday, we get the Fed meeting minutes from the July meeting, and every word, every sentence was key in this in terms of solidifying the view that I adapted the day of the last Fed meeting back in July, particularly because of the Fed's narrative, and in terms of what Jerome Powell said, reading between the lines in terms of what Jerome Powell said, the nuance of the way he said it, the words he chose to use, all right, that the Fed's narrative had begun the shift on that day, a month ago almost now, from fighting inflation to protecting growth. And man, if these meeting minutes didn't scream that, we're going to break it down line by line. And when you throw in the fact that you have meeting minutes that, frankly, were kind of dovish, if you ask me, I really don't even see. It basically says not every member's convinced they're going to raise 50 in September, let alone thought they were going to raise another 75. That's not happening. And I said back at the July meeting, the day of the July meeting, after the press conference, that I would lay odds that the chances of the Fed doing nothing are better than the chances of the Fed hiking by 75 basis points. And that is more true today than it was then. So for when you take all of this together, flat retail sales, the Fed spewing, more about future economic weakness, spewing dovish, all right, you're looking at rates in the forwards in the Fed funds market rose, the 2-year note yield rose, and it's kind of like, what's going on there? So we'll take a look at all of that and how this then really failed to stir anything in the dollar. The dollar's kind of overcooked. It's hanging over its skis here relative to the interest rate differentials. And in that case, monetary conditions are still tightening, but it kind of is the dollar almost that looks like will be the ultimate maybe relief valve there. Not the best environment for gold, not yet. And if you get below 1753 in gold, it's not going to look good at all. So we take a look at all of that in today's double 2-for-1 Thursday Weldon Live. Go straight. And again, same thing. Do we think this is the correction? Didn't even make 38% of this. Okay, the XLY did. The S&P 500 did not. That's kind of a problem to me. Then part 2, we get to the Fed meeting minutes. Oh my God, this was amazing. It's like I couldn't have written this any better to make my point that I made a month ago. Holy mackerel. Thank you for giving me the validation that I was bang dead on. All right, that the shift is underway, as subtle and as long as it might take to get there. All right, as much as they have to remain looking, at least vigilant on inflation. I'm not saying this is something like bang, it's turned. I'm saying, but the shift has started, absolutely positively. Here's the first page of text. Investors appear to be increasingly attentive to the downside risk in the economy, reflecting expectations of slower growth. And they're also seeing, they mentioned this 3 times, a decline in inflation compensation, which means the tips or whatever. The Treasury, inflation protected securities. So the market's pricing less inflation, and investors are worried about downside risk in the economy. That's it right there. There's the shift. The market participants see lower inflation ahead. Okay, the surveys from the Fed desks expect inflation to decline substantially. And talking about the market measures suggest inflation would ease in coming quarters. Every one of it. Okay, I said this in July, and now I know it. This is the shift. All right, we see it. And they were doing this a month ago. This is a month ago. Pointing to lower inflation ahead. Desks, again, suggest would ease in coming quarters. Is that a double? No, that's the same one. And then this. You're talking about the most expected a 50 basis point increase in September to follow. Okay? No, most is not all. All right? So some people do not see 50 basis points. Maybe they see 25. Maybe they see nothing. All right? Again, I said this before. I say it again. I'm saying it even louder now. The chance that they do nothing is greater than the chance they go 75 again. It's case closed, by far. Yes, as Marv would say, from downtown. Yes. Indicating peak policy rate significantly lower than the June meeting, number one. Expectations that the policy rate would fall thereafter. Okay? And on average, talking about probabilities of lower rate outcomes. Dovish, dovish, dovish. 1, 2, 3. Not only that, but when you're talking about lower rate outcomes than the long LRR or LRP, right? Long run policy rate. LRPP. I guess it would be the LRPP. Of 2.4%. I mean, that would mean 100 basis points of rate cuts in 2024. I mean, hello, how much more dovish can you get in Fed policy minutes than to basically play out 100 basis points of easing on the downside risk of probable outcomes for 2024? That's dovish, man. That's not priced into the market at all. At all. Not one bit, man. And this is why I get juiced on this, man, because to me, this is really pretty clear, man. And I just don't know. Maybe I've lost my touch, man, but I don't think so. I mean, we've seen this how many times? How many times have I been early? I mean, and it's not like I'm early for 3 years and I'm wrong, but saying I'm early. This one is coming. Communications. All right, this was really interesting because the Fed is concerned that just even the way they're talking so hawkishly now, that maybe this is doing damage to the economy, especially in the housing market, quote unquote, interest rate sensitive sectors. We know that. Another low, by the way, in all the MBA mortgage indexes on Wednesday. Low, new lows with big declines again, even though the mortgage rate fell for the week. I mean, that's just bad all over the place. And says, policy dovish going forward, relatively speaking. I'm not saying dovish, all right? Let me choose my words more carefully. Participants judged the bulk of the effects on real activity, just even from the rhetoric, had yet to be felt because of the lag with transmission of monetary policy. The effects of policy actions and communications were showing up more rapidly than historically has been the case, because how quickly they've moved. And that's led to a significant tightening of financial conditions. So they're saying we have this as impacted more quickly. It's a significant impact on tightening in financial conditions, more so than we thought it would be, and more quickly than we thought it would be. And yet the bulk of the transmission hasn't even hit yet. Holy mackerel. Why would they be tightening again aggressively in September? They wouldn't. But the market doesn't see it that way. The gap between the 2023 and 2022 forward Fed funds implied rates has narrowed to almost nothing. It's back to like 7, not even 7 basis points. All right. The peak rate's, 350. Okay. And that's kind of where it's been at its high. All right. But you have removed all thought process around rate cuts in 2023. All of them. Not only that, the 2-year did exactly what I suspected yesterday it might do and was hoping it wouldn't do, which is break out to the upside. But that's exactly what it did. But on what? Retail sales were strong because the Fed said more rate hikes will be appropriate because that was their stance going out. Of course they have to say that. They have to be vigilant on inflation. It's still 8.5%. If you read between the lines, there is nothing hawkish about this Fed minutes. This Fed minutes is more dovish than was Jerome Powell's press conference. It's that simple. Actually, that's the way to look at it. All right. The benchmark 2-year price is on the verge of breaking down here. It gapped down. Notice how it closed below the opening, though, the black bar, because it closed above the open. That's interesting. All right. In the meantime, the 2-year's gotten ahead of the long end, but even the 2-year's starting to come in vis-a-vis the U.S. versus German 2-year bond yield spread, leaving the dollar hanging out to dry potentially up here at 106. Maybe closer to 100 or 97, which is exactly what we've been looking for. On the short term, the dollar has run into a buzzsaw at 107. It cannot get through 107. Twice this week it has failed. Twice it has closed back down here at the 106, below 106.50. This is bad price action against momentum that has completely disappeared, against the downside that is vulnerable from a Fed that is clearly beginning to shift. 104.60 and then 103.85 would be huge downside pivots on a short-term basis on the dollar. We see the dollar 101 and then 97.50. Having said that, because the 2-year's up and because, in fact, the dollar isn't actually going down, monetary conditions continue to tighten. The trend continues to tighten. Look at the 52-week against the 2-year on the gold-adjusted value of the dollar. I mean, this is still higher. It's higher on the week, it's higher on the month, and the moving averages are closing higher here and threatening to cross over for the first time since 2018. That's not good for gold. And thus gold continues to feel heavy. It just feels heavy. I mean, you got up here through the 50-day, but you couldn't even get to the 38% retracement and the 200-day moving average. You ran out well before you hit the 100-day, and you had a downside tail reversal. Then a second-day reversal here on Monday. So, yeah, you closed off the low. That's okay, but it just doesn't feel good. If it gets below 1753, that's going to cause us to cringe, and we'd have to bail on what still is a bullish gold position here, along with copper, along with natural gas, which is above $9, by the way, and running around to the upside. Keep an eye on that, too. Bearish the dollar, bullish the S&P 500. WeldonLIVE is the research that pays for itself.